option traders. For today's trade, we're looking at an option strategy known as a cash secured put in Delta Airlines. This is a great strategy to use if you're looking to buy a stock at a price below the current one, or it can also give you a nice boost to the yield. Looking at DAL on MarketSmith, shares are trading just 3% below a cup with handle buy point of 40.44. The stock has been building this base since April of 2022. Additionally, that base is within a much longer sideways trending pattern that goes all the way back to March of 2021. While forming the handle over the past few weeks, the stock pulled back to find support at its 50-day line. The pullback clearly occurred in lighter volume, which is exactly the type of action we want to see. Meanwhile, it's been rallying in stronger volume. Airliners have been showing renewed strength in recent weeks, and the group currently ranks number 50 out of IBD's 197 groups. Investors wanting to take ownership of DAL can potentially do so at a reduced price with a strategy known as a cash-secured put. This option trade is slightly less bullish than buying the stock outright and involves selling an at-the-money or out-of-the-money put while simultaneously setting aside enough cash to buy the stock. The goal is to either have the put expire worthless and keep the premium, or be assigned and acquire the stock below the current price. Selling put options is an easy place for investors to start with options. They're like a covered call and are pretty easy to understand once you know the basics. So with all that said, let's take a look at my trading platform and set up a trade using DAL.
So with DAL trading around 40 a share, investors can consider selling one April 21st expiring put with a 39 strike.
With DAL trading around 40 a share, investors can consider selling an April expiring put with a strike price of 39 for around $1.75. An investor selling this put would receive $175 into their account, which would be theirs to keep. If DAL falls below 39 by April 21st, you would be required to buy 100 shares at 39. The break-even price for the trade can be calculated by taking the strike price minus the premium received, which in this case gives us a break-even of $37.25. That's roughly 4.7% below yesterday's closing price. If the stock stays above 39 at expiration, the put expires worthless, leaving the trader with a healthy 4.7% return on capital at risk. That works out to around 38% on an annualized basis. The main risk here is similar to outright stock ownership. So if the stock plummets, the trade will definitely suffer a loss. However, the loss will be partially offset by the premium received for selling the put. The maximum loss on the trade would occur in the highly unlikely case that Delta falls to $0 a share, which would see the trade lose
$3,725.
But again, this is highly unlikely, and most traders would definitely cut their losses before then. A stop loss could be set if Delta drops below the mid-February low of around 36.66. As always, remember that if you're new to options, make sure you practice this with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment in some cases. Check out the new Options Trader app from IBD for digestible options education and tons of great trade ideas. And be sure to join us here for our regular options content, where we break down a new trade idea every day.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.